Hi, it's James here and welcome to the FX Axe channel, your #1 trading resource. As always, we will be providing transparent and informative content without the BS. Feel free to check out our other videos to take your trading to the next level. Today, we are going to be covering some of the basic things you need to understand in order to start trading Forex. So, get those thinking hats on, as today we are covering leverage, pips, and how to calculate position sizes. Before we begin, a disclaimer for you. Forex trading does carry a high level of risk to your capital, and you should only trade with money you can afford to lose. Our videos are for educational purposes only and delivered by a team with verified results. So please like, comment, and subscribe if you enjoy the content. One of the first things you will have to select and decide on when you first open your brokerage account is how much leverage you want to trade with. So let's start there. What is leverage? Well, as Investopedia puts it, leverage is a double-edged sword. It is one of the main deciding factors that brings people to wanting to trade Forex over traditional trading options. Leverage is what allows you to turn $500 into 10 grand. But it is also the reason why so many accounts get wrecked. Leverage is essentially the use of borrowed funds to increase a trader's position beyond their trading capital alone. In the case of Forex trading, these funds belong to the broker that you sign up with. So you are trading both your capital and can increase your position size by leveraging the broker's capital as well. This extra capital is what magnifies both your wins and your losses. Let's look at an example. Let's say a trader is required to deposit 100% of the total transaction value, and the trader is looking to place a trade of one standard lot on pound US dollar. One standard lot is the equivalent to $100,000, 100 grand. That is a lot of money. Most traders aren't going to have this kind of cash starting out. The use of leverage is what is going to allow a trader to trade one standard lot. Let's cover what a lot is here quickly. A lot size is the amount the trader is going to trade. For a quick overview, I will cover a micro lot, a milli lot, and a standard lot. These lots can be thought of as the contract size you want to trade. Micro lots are the smallest lot size you can trade, while one full lot is obviously bigger than a micro or mini lot, requiring more margin or capital needed to trade the bigger size. With leverage, the trader may now be required to only put up 1% of the $100,000, which is only $1,000 in order to trade a full lot. Now, trading one standard lot is much more achievable. The leverage on this trade would be 100 to 1. What if the trader only wants to put up 25% to trade a full lot? Well, then they can increase their leverage to 400 to 1. Here is a chart that shows the most common leverage levels offered by most brokerages and the corresponding amounts that traders are expected to put up as a percentage for the total value of the trade. The lower the leverage, the more capital the trader is expected to put up front. And the higher the leverage, the less money the trader needs to open larger position sizes. Leverage allows the trader to open up more positions as well as it gives them more margin to trade with. Another important reason why Forex traders need to use leverage is that oftentimes currencies are traded at 4 decimal places. Price may only move fractions of a dollar in a given trading period, going up or down mere pennies at a time. In order to make trading these moves in such small increments worthwhile, leverage is needed if any substantial amount of money is going to be made trading small movements in currency valuations. Having explained a bit about leverage, you're probably sitting there thinking, so James, you're telling me that if I have 100 to 1 leverage, that for every $1,000 of trading capital I have, I can actually trade a full lot size up to $100,000 of value? That is amazing. Well, yes. However, what sort of educational Forex channel would we be if I wasn't real with you guys and also highlighted the risks here? This is why Investopedia calls leverage the double-edged sword. So let's look at the risks. Just as leverage allows you to make more profits on your winning trades, of course, your losses are also magnified, which is why leverage is a tool that should be used carefully. keeping in mind that, like any profession, traders are likely to make mistakes and take some losses early in their career as they learn the ropes and practice their trading skills. A professional trader using leverage is like Thor using his hammer to hit a nail into a board. Sure, if he hits the nail square, that nail is probably never coming out and it was more effective than using a regular hammer. But if a noob tried it, assuming they could actually lift the hammer that is, they are more likely to miss the nail completely and probably electrocute themselves, rather than have any luck at all. So, bad analogies aside, what I'm trying to say is leverage is a powerful tool to increase profits if used in the right hands by a skilled trader, and dangerous to those new traders who are going to over-leverage, YOLO all in on one trade and blow their accounts. I will leave links to a couple of articles in the description section that dive into leverage in a little more detail if you would like to nerd out. Next, let's talk about pips. What is a pip? A pip stands for percentage in point, or price interest point. It represents a tiny measure of the change in a currency pair. A pip is the standardized unit in the Forex market, and it is the smallest amount by which a currency quote can change. For US dollar pairs, 1 pip is $0.0001, which is more commonly referred to as 1/100th of 1%, or 1 basis point. This standardized size helps to protect investors from huge losses. For example, if a pip was 20 basis points instead, a 1 pip change would cause greater volatility in currency values, causing more drawdown and margin used up per trade. Most currency pairs are quoted to the 4th decimal place. A pip represents the last and smallest of those numbers. You may hear the term pipette as well, which is a fraction of a pip, but a pip is the most basic standard measurement for currency trading. The only major pair that uses a different pip value and decimal place is the Japanese yen. With the yen, a pip is the number in the 2nd decimal place, not the 4th. Let's look at an example of this on the Euro USD. Now, if Euro USD moves from 111.60 to 111.61, price has just moved 1 pip. The value of a pip can be calculated by dividing 0.0001 by the current exchange rate. The formula for this is pip value equals pip size divided by the exchange rate times position size. Since Forex transactions are typically leveraged, the pip value of positions gets multiplied by the amount of leverage you are using. Now, by knowing the pip value of a currency pair, you can apply money management techniques to calculate the ideal position size for any trade within the reasonable levels of your account size and risk tolerance. Without knowing this, you might end up taking either too much or too little risk on a trade. Now that we covered pips, let's look at calculating our position sizes and iron that out. Calculating your position size is crucial to avoid taking on too much risk, or too little. You don't want to be risking any more than 3% risk max on a trade. Most traders aim for 0.5 to 2% risk per trade. If you don't know how to calculate your position, you have no idea how much you are risking. So this step is important. Once you've determined how much you want to risk per trade, let's say 2%, you need to determine your pip risk. Now, your pip risk is the difference between your entry price and where you place your stop loss. So now you have how much you want to risk, your pip risk, and your pip value. So you can use this formula to determine your position size. Take the amount of money which is determined by the risk percentage of your total account size, divide that by the pip risk multiplied by the pip value, and that will give you your ideal position size. Let's look at an example. Let's say you have a $5,000 account. You risk 2% of 5,000, which is 100, divided by 90 pips, which is your pip risk, multiplied by pip value, which in this example is $1, and that gives you a lot size of 0.11. Easy, right? Well, easy, but annoying if you really need to work all this out each time you want to place a trade. Now, I know what you're all thinking as you are struggling to stay awake during this boring math lesson. I know, math blows. I've never liked it either. Lucky for you guys, this brings us to our FXAX tip. And that is, thank goodness that there are tools out there that work all this out for you. Instead of sitting there calculating all this stuff out every time you want to place a trade, allow me to direct you to the MyFXBook Position Size Calculator tool. Those handy folks over at MyFXBook have thought of everything to make your life as a trader a lot easier. With these position size calculators, you could just punch in some basic numbers and the proper position size will be calculated for you. I will leave the link for this tool in the description below. And that about wraps it up for this video. I know we covered a lot of content here, and subjects such as leverage and pips can require a lot more detail than the basics we covered here. Keep an eye out for future videos on these topics, and I will link some additional resources in the description below if you care for a deeper dive into these topics. I hope you guys found this video helpful. Here at FXAX, we are passionate about bringing you all the information, education, and content you need to help each of you reach your trading goals. Thank you for watching and stay tuned for our future content. If you have not already done so, feel free to check out our newsletter, Telegram, and Instagram where we post daily Forex analysis. All those links can be found in the description below.